Our next guest says rate cuts are looking more likely following today's CPI report. He's calling for 100 basis points by year end, starting with 50 next month. For more, let's bring in Barry Knapp, Director of Research at Ironside's Macroeconomics. Barry, it's great to have you on. We have this market melt up here on the heels of CPI. Does it make sense to you?
It does. The market, until today at least, was increasingly narrow, driven by the whole Gen AI theme. For a couple of years, we've had pressure on small businesses, small banks, the credit channel, as a consequence of the way the Fed tightened, which was primarily using rate policy, as opposed to reducing their balance sheet more aggressively, something Steve and I have talked about, Kelly and I have talked about a lot. And you could still see that in return on equity on the small banks, which is running below 8%, below their equity cost of capital, whereas it's nearly 12% for the big banks. And so getting to the point where the Fed actually creates an upward sloping 3-month, 10-year part of the curve, not just 2s, 10s, but gets those deposit rates down, which are far less sticky when rates are going down than they are when they're going up. That'll really reopen that credit channel and provide that credit to small businesses, take a lot of the financing pressure off. And so that rally is being driven by, the expectations of rate cuts, which, as you said, I think there's a good chance they start with 50. And the way I get there is on September 9th, when we get the first estimate of the annual benchmark revision, it's going to look something like last year, negative 800,000 or so. And the Fed is going to realize not only were the revisions really ugly for the last month, but we're actually looking at a much slower job creation rate, such that, supply of labor is coming down, but demand has weakened a lot more. And they really ought to be loosening policy, as I said. And then the small caps are the big beneficiaries of that.
Fed. Steve, you are the resident Fed whisperer. What would it take for the Fed to get to a 50 basis point cut, especially on the heels of this inflation print?
Well, if the Fed believed there was still snow in Aspen, the way it is behind Barry Knapp right now.
I'm glad you brought that up.
That might create an issue, I believe, where they might be really concerned about things like, reverse climate. But anyway, I think I'm not sure the Fed is going to be as animated by the benchmark revisions as they will be by if there's another lousy September report, another calm inflation number. We are hearing people stake themselves out. Schmidt today was important. He's a voter, and he basically said no cuts coming. Alberto Musalem from St. Louis, he's also sort of staked that out. Daly could go either way, Barkin kind of in the middle. So there's still a debate to be had. I think the Fed, in order to create harmony and not have them sort of tearing at each other, if it starts in September, will start small. And unless the data scream 50, it'll be 25.